Hey everybody, I'm Don Fishback, and we are talking about the market and how it's been crazy the last few days. We had 1,000 down on Monday. What was it, Brian? Was it 900 something yesterday? It's down again today. And I think it's kind of funny because people forgot last week. I think Friday was down. What was it, down about 300, the Dow was? So, I mean, it's that, yeah, everybody says, well, that's two big declines. Friday was a pretty big decline too. And the reason why I mentioned that is I was asked for the Option Masters live event coming up, what I thought about the market, where do I see the market, what am I doing, where's the best opportunity. And one of the things that I said was I wanted to be a buyer of calls. I didn't pick a sector or anything like that. I wanted to buy calls. And I wanted to talk to everybody about that because this is a perfect example of why we like options so much better than some of the other things that you can do with your money. And I'll give you an example. And I was talking to Brian and Terry and Brian over there and James. And James brought in our attention to an article this morning. And James, what was the title? Do you remember the title of the article?
Time to immunize your portfolio against the coronavirus with optimal SPY puts.
Yeah, well, you know what? That's like, when was that article? That was this morning, right?
Yeah.
That's like 2,500 points too late. But anyway, I mean, you're already half dead. But so now is not the time to be optimizing or immunizing your portfolio with optimal SPY puts. That time to do that was back when I was talking about buying calls, what do puts, immunizing your portfolio with puts, what does that have to do with calls? And the reason why, if you start to think about it, and Brian, I was asking everybody else this morning, what does a married put look like? And a married put is where you have a stock and you buy a protective put. Or in this case, you have a portfolio that, let's say it mimics the S&P 500, and you buy a protective put. SPY is the ETF on the S&P 500. So you buy a protective SPY put. And what's it look like? And Brian, you came up with the answer. What was it?
It looks like a call option.
It looks exactly like a call option. It's a call option. You have the gain, so you have that gain where it keeps going up. And I'm backwards, so they're going to be like, it's going to be, if the stock goes up, it's going to be going up. And then if the stock goes down, the stock is going to continue down, but the put's going to start to make money, and that's going to cause the further loss to stop. Well, what does this look like? That is a call option. So that's why we like call options. So the question is, do I put half my portfolio in a call option, or do I put the whole thing in? And you never do that. And the reason you don't is because you buy a bunch of calls with all your money, and the market goes down, you get wiped out and you're done. You put 50% of your money in call options, and the market goes down, and you just lost half. So what should you do? Is there a right number? And we've got this service, and I'm not going to talk about the service or anything like that, but it gives you an idea of how this performs. It uses a selection criteria for buying calls, and it's a great thing. It really gets the calls that are going to do well, not because the stocks do particularly well, but because the calls themselves do well. And what we found is that if, let's say you have a $100,000 stock portfolio. Just imagine you have a $100,000 stock portfolio, and you said, I want to match the S&P 500. And we're going to go back to 2002. And so I'm going to go back to 2002. I'm going to start at that with $100,000. And how much money would I have to put into the options? So out of that 100,000, how much would I have to put into the options in order to get the same performance as if I took the whole $100,000 and put it into stocks? Everybody follow that? The percentage of the portfolio I put in options so that the portfolio of options matches the whole portfolio in stocks. And the answer is 4%. So you only put yeah, it's actually about 3.5%. About 3.5%, 4%, right in that neighborhood. So you just put 4%. So let's just say it's 4%. And then, now right now, just a little while ago, I was looking at the market. From its peak, the S&P 500 is down 8%. So it's down 8. So the question, just think about this. If you put all your money in the stocks, $100,000 in the stocks, you'd be down $8,000. If you put it in the options, you would only be down $4,000. And that's assuming they're at a 100% loss, which they're not. So you're cutting your losses in half by using the options. Somebody asked me the other day, are options riskier than stocks? And the answer is yes, if you're stupid. So all you got to do is not be stupid, and you can actually reduce the risk in using options from what you get in stocks. And so now we've got, imagine again, you've got all your money in stocks, $100,000, and you've got only $4,000 in the options and the other 96 in a money market. When the market goes up, those options are going to make you money. Not at the same rate, but close enough to it. And then if it keeps going up, then those options will actually make more money than the stocks. So you get a huge benefit on a big bull market with options, which is one of the things we've had since about 2009. So you outperformed in the bear markets. It did great. This method did great in 2002. It did huge in 2007 and 8 and 9. You can imagine you were just losing little chunks while the stock market was getting crushed. And then when the rally came, you participated all the way back. So anyway, that's the way to use options to actually reduce your risk so that you have less risk than investing in the stock market. Anyway, I'm Don Fishback, and I want to thank you all for watching. Be sure to sign up, subscribe, let us know how you give us a like or any kind of comments. Let us know how we're doing. And thanks again. Bye now.